Imagine a world without money. How would you get the things you need? Long ago, people relied on a system called barter. It was simple. You traded what you had for what you wanted. A farmer with extra grain might trade it to a shoemaker for a new pair of boots. This direct exchange of goods for goods seems straightforward, but it came with a big problem. The double coincidence of wants. The double coincidence of wants means both traders need to desire what the other has. Finding that perfect match wasn't easy. What if the shoemaker already had enough grain? What if they wanted tools instead? Barter limited trade and made it difficult to get what you needed. It was inefficient, to say the least. Just imagine trying to buy groceries with a flock of chickens today. The limitations of barter were clear. People needed a more practical system. They needed something that could represent value consistently. This realization led to the search for a common medium of exchange, something we now call money. As civilizations evolved, so did their solutions to the barter problem. People began to recognize the value of certain commodities. These commodities, while useful in themselves, took on a new role: money. Salt, a vital ingredient for preserving food, became a sought-after form of currency. In fact, the word salary originates from the Latin word for salt, salarium. Shells, durable and easily transportable, also emerged as a form of currency. Cowrie shells, in particular, were highly valued and traded across vast distances. In some cultures, livestock became a symbol of wealth and a means of exchange. Cattle, with their practical value as a source of food and labor, were particularly significant. These early forms of money, although a step up from barter, were not without their flaws. Salt could be cumbersome to transport, shells were susceptible to counterfeiting, and livestock, well, they needed to be fed and cared for. The search for a more durable, divisible and portable form of money continued. This led to a pivotal moment in human history, the advent of metal money. The discovery and use of metals marked a turning point in the evolution of money. Metals like gold and silver possessed unique properties that made them ideal for currency. They were durable, divisible, and relatively rare. Initially, people traded gold and silver by weight. Imagine carrying around scales to measure every transaction. Then, around the 7th century BC, a revolutionary idea emerged in the kingdom of Lydia, present-day Turkey. They created the first standardized coins. These coins, typically made of electrum, a gold and silver alloy, bore the official stamp of the kingdom. This stamp served as a guarantee of the coin's weight and purity. The invention of coinage was a game-changer. It standardized transactions, making trade more efficient and trustworthy. Coins could be easily counted and transported. They didn't decay like grain or die like cattle. The use of coins spread rapidly throughout the ancient world, facilitating trade and fostering economic growth. The era of metal money had begun, laying the foundation for the sophisticated monetary systems we have today. Section 4. Paper promises. The birth of banknotes in the East. While coins revolutionized trade, carrying large sums could still be impractical. Imagine lugging sacks of coins to buy a house. In the 7th century China, during the Tang dynasty, a new form of money emerged: paper money. Initially, these banknotes were essentially promissory notes. They represented a promise to pay the bearer a certain amount of copper coins, which were bulky and difficult to transport in large quantities. Merchants and traders found these early banknotes far more convenient than heavy strings of coins. The use of paper money spread throughout China, facilitated by the establishment of government-backed institutions that issued and regulated these notes. This innovation, however, didn't reach Europe for several centuries. The concept of paper money was revolutionary. It demonstrated that money didn't have to be a physical commodity. It could be a representation of value backed by the promise of an issuer. This idea paved the way for the development of more complex financial instruments and institutions in the centuries that followed. Section 5. Building trust, banks, credit, and the rise of modern finance. The use of paper money led to another significant development: the rise of banks. Initially, merchants acted as money changers and safekeepers of valuables. This evolved into the establishment of formal banking institutions. Banks issued banknotes, accepted deposits, and facilitated loans. The concept of credit emerged, allowing individuals and businesses to borrow money and repay it later with interest. Credit fueled economic activity, enabling investments and fostering entrepreneurship. However, it also introduced new complexities and risks into the financial system. As banking systems grew more sophisticated, so did the instruments of finance. Governments began issuing their own currencies, backed by their national reserves. Central banks emerged to regulate monetary supply and ensure financial stability. The world was moving towards a globalized financial system, interconnected and complex. Section 6. Digital dollars, credit cards, crypto, and the cashless society. The late 20th and early 21st centuries witnessed a dramatic shift towards digital forms of money. Credit cards gained widespread adoption, allowing people to make purchases on credit and defer payments. The internet and mobile technology further accelerated this trend, giving rise to online banking, electronic transfers, and mobile payments. Then came cryptocurrencies, decentralized digital currencies using cryptography for security. Bitcoin, the first and most famous cryptocurrency, emerged in 2009, sparking both excitement and debate about the future of money. Cryptocurrencies operate independently of central banks and governments, offering potential advantages like anonymity and lower transaction fees. This digital revolution transformed how we interact with money. Cash transactions are becoming increasingly rare in many parts of the world. The convenience of digital payments is undeniable, but this shift also raises concerns about privacy, security, and the potential for financial exclusion. Section 7. The future of finance, biometric wallets and beyond. As technology continues its relentless advance, what does the future hold for money? Will we still be using credit cards and cryptocurrencies in the decades to come, or will entirely new forms of exchange emerge? Biometric authentication, using unique biological identifiers like fingerprints or iris scans, is already being integrated into payment systems. Imagine a world where your body becomes your wallet. Artificial intelligence and blockchain technology are poised to revolutionize finance further. AI-powered systems could personalize financial services, offering tailored advice and managing investments. Blockchain, the technology underpinning cryptocurrencies, has the potential to create more transparent, secure, and accessible financial systems. The future of money is likely to be a fascinating blend of the physical and digital. While the form money takes may continue to evolve, its fundamental function as a medium of exchange, a unit of account, and a store of value will remain essential to the functioning of human societies. One thing is certain: the journey of money, from bartering chickens to biometric wallets, is a testament to human ingenuity and our constant quest for better solutions.